Okay, let's dive right into this. Welcome to The Explainer. Today, we're unpacking a massive central mystery happening right now in global financial markets. Gold, historically the ultimate safe haven asset, the exact place investors run to when inflation spikes or geopolitical tensions rise, is plunging. And we're going to break down exactly why this is happening.
Right out of the gate, we're seeing gold post 3 consecutive red monthly candles. This is the first time we've seen a streak like this since June of 2022. Since hitting its all-time high of $5,589 back in January 2026, it's been hit with a brutal 16% crash. Now, here's the crazy paradox. Global inflation just hit 3.8%. Usually when inflation is running that hot, gold is soaring, but instead, it's plummeting.
Let's move through the roadmap and see how this all builds. Recovering the recent price plunge, the macro drivers, retail versus institutional flows, the technical bear case, the fundamental bull case, and finally, what we can expect to see next.
Part 1. The recent gold price plunge, an $11 billion warning.
So this isn't just some minor blip. We're talking about a wealth-erasing event on a sovereign scale. Gold has plummeted roughly 16% down to the 4,400 range. To put the real-world impact of a drop like that into perspective, consider a nation like Lebanon. Because of this sharp, sudden drop from 5,600 down to 4,400, Lebanon saw an estimated $11 billion in book value literally wiped from its national gold reserves in just a matter of days. It's just a staggering evaporation of wealth, and it really shows you how high the stakes get when an asset this massive corrects.
Moving to Part 2, macro drivers behind the downtrend, the chain reaction.
So, what actually triggered the downtrend? Think of it like a global chain reaction of dominoes falling. First, reports of a potential Iran-US ceasefire framework eased tensions in the Middle East. That stripped away the geopolitical risk premium that was keeping gold artificially high. Simultaneously, previous conflicts had already pushed oil prices up, which kept inflation stubbornly hot. That hot inflation cemented fears that central banks are going to keep interest rates higher for longer. And as we know, higher rates strengthen the US dollar, making gold way more expensive for foreign buyers. Then the final domino falls, and gold drops.
Now, what's really interesting about this data is the role of real yields, which is just the difference between nominal interest rates and inflation. Gold and real yields share a massive historical negative correlation of negative 0.82. It's essentially an ironclad rule of the markets. When real yields go up, gold goes down.
Ultimately, it boils down to opportunity cost. Gold is a non-yielding asset, right? It doesn't pay you interest or dividends just for holding on to it. And right now, with CME Group data showing a nearly 40% probability of a Fed rate hike by December, institutional money is naturally fleeing to high-yielding cash and bonds. It just makes sense.
Part 3. Retail versus institutional investors. A market divided. That institutional outflow we just talked about reveals a totally fascinating tug-of-war. Just spotlight this number for a second. $60 to $70 billion. According to the Bank for International Settlements, that is exactly how much everyday retail investors have aggressively poured into gold ETFs over the last 6 months alone just to buy the dip.
The BIS actually calls this retail buying exuberance. And why is that? Because while everyday folks are buying, the big institutions are doing the exact opposite. Institutional selling has been accelerating since late 2025, and when you combine that massive institutional offloading with forced liquidations in leveraged ETFs, you end up with a market experiencing these violent, amplified downside swings that completely override all that retail buying pressure.
Over to Part 4, the technical bear case, charting the drop.
If we look strictly at the technical charts, completely impartially, gold has been caught in a very clear bearish channel and a flag formation. The immediate battleground right now is heavily testing the $4,400 and $4,350 support zones. These are the crucial floors the bulls are desperately trying to defend.
But if those floors break, the bearish projections are strict. If that $4,350 support level shatters, technical analysts warn we could see a cascading slide. The immediate target then becomes $4,200, followed by a deeper plunge toward the psychological $4,000 mark. And in an extreme worst-case technical scenario, we could be looking at a prolonged crash, dragging the price all the way down to $3,800.
Let's flip it for Part 5, the fundamental bull case, the buyers beneath.
And this brilliantly illustrates the other side of the argument, because the charts really only tell half the story. While Wall Street is out there dumping paper gold ETFs, sovereign nations are quietly stacking the physical metal. In the first quarter of 2026 alone, central banks devoured a massive 244 tons. Poland added 31 tons and China added 7 tons. You have to remember, these aren't day traders. These are sovereign nations strategically diversifying their reserves away from the US dollar for the long haul.
And it's not just central banks. Everyday physical demand for actual gold bars and coins surged 42%, hitting its second highest quarterly level ever recorded. When the price dropped, physical buyers didn't panic at all. They stepped right in and bought more. This suggests that despite the vicious sell-off in the paper market of futures and ETFs, there is a very durable, fundamental floor sitting under the actual physical price of gold.
Bringing it home with Part 6, What to Expect Next, the Price Forecasts.
So, the crucial point is, where do we actually go from here? Well, look at the institutional consensus. Even with this brutal 16% plunge to the $4,400 range, heavyweights like JP Morgan and UBS universally project gold to rebound significantly by the end of 2026. JP Morgan expects prices to push past $5,055 for the Q4 average, and UBS still sees it hitting $5,500 by year-end. They clearly believe these current macro headwinds are strictly temporary.
And because perfectly timing the bottom of this kind of volatility is essentially a fool's errand, experts lean heavily into dollar-cost averaging here. Removing the emotion and just mechanically building a position allows you to ride out all this noise while the market naturally finds its true floor.
So, we've unpacked the macroeconomic domino effect, the aggressive institutional selling, the scary technical charts, and the massive fundamental buying happening from central banks. So, I'm going to leave you with this question to weigh based on the evidence we've covered today. Are we currently looking at a once-in-a-cycle fundamental buying opportunity, or is this 16% drop just the very beginning of a prolonged technical crash? The tug-of-war happening in the markets right now is absolutely fascinating. Thanks so much for joining me for this explainer, and remember to keep your eyes on the data.